thrill seekers out there, or should I say nervous Nellies, I spoke with Roger Montgomery about the stocks with the highest margin of safety. Now, this is your decision. You thought you go looking for stocks with a high margin of safety. What does that mean?
It means that there's a big gap between the price and the intrinsic value. So as you know, I calculate the intrinsic values of every company listed on the Australian Stock Exchange.
And no one knows how you do it. It's a bit like the recipe for Coca-Cola, which reported today, didn't it?
Yes, it did. And it is secret herbs and spices.
Actually, it was yesterday, but still.
To be fair, the basic recipe is in my book, Value.able.
Yeah, and Benjamin Graham also. He was into intrinsic value as well, wasn't he?
Well, yeah, but if he'd had a computer, he might have come up with a different formula.
Ah.
You know, his was before the days of the computer.
So I can go to bed tonight thinking, Roger Montgomery is actually better than Benjamin Graham.
Gee, I wish that were true. You never know in 100 years what people might think.
It's true.
You never know.
You could become an icon.
I might dust off Value.able in their granddad's attic or something, and they'll say, "This is it. This is it. How come no one talked about this before?"
Because it's too bloody confusing. That's why. But anyway,
I hope that's not true.
No, it's not true. I was being harder. But I'm going to say, I've read the...
You've read it. You didn't think it was confusing. You told me you liked it.
No, it's a great book. But I think for some people, they would need some hand-holding along the way.
The reality is, if you could reduce all of that to a green button and a red button, a green for buy and a red for sell, people would be very happy.
Well, my next bestseller is going to be Roger Montgomery Made Easy. Roger Montgomery for Dummies. Right, let's get on with it.
Okay, so what I decided to do was I decided to take a look at the market. So I scanned the entire market and I said, okay, let's look big cap stocks, big caps, because I remember last year we talked about blue chips, you know, and I thought, well, let's stay on that sort of thing.
Yeah, and you didn't even like the blue chip definition, did you?
No, well, I don't like the conventional definition of blue chips. I think you can have a small company that hasn't been around very long, could still be a blue chip company. Yeah. I don't like the conventional definition. And then I decided, okay, we'll look for companies that have a yield of greater than 3%.
Yeah, people like that.
So there's something there, and if they're growing, if the businesses are growing, well, that yield will eventually increase over time.
Good point.
And I want to look for companies, don't want to look for anything below sort of B3s. You know, I scale companies, I rate them from A1 down to C5. You don't want to look down the bottom half.
So are we talking A's and B's or mainly B's?
A's and B's.
Okay, good.
A's and B's. And I look for companies that have a margin of safety. Now, here's the interesting thing. I've ranked them. So from the highest margin of safety to the lowest margin of safety. Unfortunately, there's one company that actually has a positive margin of safety. So there's one company today trading at a discount to its intrinsic value using that criteria. A dividend yield above 3%, a forecast dividend yield above 3%, large cap company, A or B quality, A1 down to B3 or thereabouts, and trading at a discount. Well, I could only find one.
Okay.
And I'll reveal that one. That was ANZ Bank.
Really?
ANZ Bank is trading at an 8.65 or 9%.
Isn't Mike going to love you tonight, sitting up with his cup of cocoa watching us?
Do you reckon he'd have a cup of cocoa?
No, he's more like a Scotch, I reckon.
Yeah, I'd say it's a Scotch. I'd say it's a Scotch. And in a very good quality glass, I suspect.
I think so too.
I sort of get that feel he'd like a nice glass.
Chesterfield Lounge.
A Chesterfield, an old...
A smoking jacket.
Old heated cracked leather, you know. Okay, so ANZ was the only one trading at a discount. It's an A3.
What was the intrinsic value for that?
Well, I'd have to actually pull that up for you. Just bear with me.
It's worth it, given its uniqueness.
Well, it's at a 9% discount to its intrinsic value. Okay. So I've got intrinsic value at 26.50. Yeah. It's trading at 24.20 or thereabouts. Okay. Yep. So
we'll see if we move the market tomorrow, mate.
I'd be surprised. It's a highly liquid company.
And the financials are under pressure. But I think we're becoming pretty influential.
I should say, there's someone watching the program tonight who works at ANZ, and her name's Linda, and I had lunch with her and Richard Wall yesterday. Okay. Used to work with Richard many years ago. Yeah. And they're watching the program tonight. They're very big fans, so I'd like to say hello to them.
Okay, fair enough.
But ANZ, I think ANZ's going quite well. I think the rollout in Asia is going to work for them. I think that's the right place you want to be globally.
But in the past, CBA's been the bank.
CBA is the best performing business economically. CBA generates the highest rate of return on equity. And if you could buy CBA at a discount to intrinsic value, which we were able to do last year, we're not able to do it today.
No.
So if you're able to, last year, and it did very well. In fact, for a while there, it was the best performing bank. And that's because it was performing the best economically, and it was also at a discount to intrinsic value. So you had two things going for it. Today, you've only got one thing going for it. It's the best performing bank economically, but it's not cheap.
So let's move in.
ANZ's cheap.
Okay, so it was at the top of your list. Is your second one then the one with the smallest negative safety
it's
margin?
trading at the smallest premium, smallest negative margin of safety.
Okay.
Yeah, so that's the National Australia Bank.
Okay, no.
So that's next. Behind that...
But just for people to understand what we're talking about, can you give us both the intrinsic value and the share price?
Yep, we can do that. That's easy. We've got current price of $24.20 again. And hang on a sec, I've just got to, let me just clear that. Bear with me. It's trading at a 0.2% premium to its intrinsic value. So it's trading, $25.82 and its intrinsic value is $25.77. Yeah, so it's line ball. It's not even a percent away from intrinsic value, but it's right on it. Okay, so if we go back to another one, Westpac. Westpac's trading, again, about the intrinsic value at its share price. So it's trading at $23.66. Woolworths is the next one. It's trading at a 2.5% premium to its intrinsic value. So I've got intrinsic value for Woolies at $25.90 at the moment. And it's trading at about $26.50.
Okay, then this is
so it's pretty close.
This could be a crossroad. I'm not saying we are, but we could be at a crossroad.
Well, I'd say consensus opinion agrees with you because since 2007 the share price has gone sideways.
Exactly.
You know, it hasn't done anything. But intrinsic value, the performance of the business has actually been improving in that time. So while the opinion is, oh, it's no good, and Coles is better, look at the great turnaround going on there. Well, you know, the share price has been left in limbo, and the intrinsic value has been picking up. That's precisely what I want to happen.
And another reason why I'm having this discussion with you is that people watching this program could dive into Woolworths and not realise that the intrinsic value is not a given. It's a movable feast. It can go up. It can go down. Of course. And of course, this is the point of the exercise. Without boasting, the intrinsic values I've come up with are pretty good. Of course they are, but unless we know every day how they change.
Yeah, well, that's why you get me on every fortnight to talk about these things. And I'm delighted to do it.
But remember, this is always an educational thing for everyone watching the program, including me. I learn stuff, believe it or not, listening to you.
I actually think the intrinsic value for Woolworths is going to continue increasing. Ignore that compliment.
I just said to you, I even learn stuff from you.
Well, I appreciate that. I think you're too kind.
Guru.
I think you're too kind. Okay. But look, you know, people who bought Woolworths back in 2007 have made no money out of capital. There's been no capital appreciation. They've lost money. Dividends been all right. But back in 2007, it was an extraordinary premium to intrinsic value. It was expensive compared to its value. It's only now that it's trading at its intrinsic value again. This is the second time in a decade that that's happened. Why? Because all the press is bad. All the sentiment, you've just given it to me, you know, all the sentiment is negative towards the company. But you go over and look at Wesfarmers and it's expensive. You know, it's expensive compared to its intrinsic value. You've talked to them about their return on equity, you know, and their return on equity, they're hoping that they can get that up. But at the moment, this is a better performing business.
Go to the next one, Roger.
Okay, the next one. The next one is Commonwealth Bank of Australia, trading at a 3.5% premium to intrinsic value. So it's interesting. We've covered all four banks. You know, so ANZ cheapest, NAB second cheapest, Westpac next, and then we've got the Commonwealth Bank next. So
those people who like dividends and want a degree of safety, the banks are a good play, aren't they? Let's go to the next one.
Okay, next one. Telstra.
You got Telstra.
Hang on a sec. Okay. Trading at a 25% premium to its intrinsic value. Okay, so its intrinsic value is significantly low. Big jump there. Dividend yield of about 10%. AMP is the next one, trading at a 28% premium to intrinsic value.
So you're saying that the market price of AMP is in a sense 28% too high?
It's about almost a third higher than its value.
If your dad said to you, Rog, I'm holding AMP, should I stick with them, mate?
I'd say, Dad, you know, just sell AMP.
Watch Switzer.
Let me look after you, mate. Who put you into that?